Hello, hello, hello. Welcome to our stock trades. I didn't even, cleaned up my face. I just literally came back from the hospital. Very been so busy. It has been insane. Um, oh, that's a little video there. How are you doing, guys? Miss you guys a lot. Hope everything's been well. Stock market's definitely been on a fritz. We have a lot to talk about. Most likely, we're going to make other videos to essentially conglomerate what's been happening and show you the due diligence that I've been doing alongside our stock alerts platform. But yeah, I want to just say hi. Hope everyone's doing well. I miss you guys a lot. Just wanted to hang out with you guys. It's been a while. I wasn't gonna do a video right now, but decided to come on in and see how things are going. So let me just drink some water here. All right, so just the first thing on the update here, I wanted to just to share with you guys. So if you go here to our Al Stock Alerts, this is for our Al Stock Alerts members and our mastering stock market students. We added a new auto heat map. I find this really nice, depending on your learning style, how you learn. Let's say, for example, you want to look at a heat chart. You don't have to type in any commands. In fact, this should be effaced. You shouldn't be able to type anything here. But if you go ahead and look, our heat map will be sent to you every hour. So 2 p.m., obviously, when the stock market's open, it's 2 p.m. Arizona time. So it may be different for you. 2 p.m., 1 p.m., 12 p.m. The beautiful part about this is, like, for example, it sent its first message today at 7 a.m., right? We saw that a lot of money came in utilities, okay? And then we started to see a shift: energy, healthcare, materials. And the beautiful part about all of this is that you can see exactly where the money is going, right? And where Wall Street's heading their money. And you can track that, and it can help you with your trades. You can use that with our scanners. Or you can, if you want to look at a map, this sends it to you automatically. So this is today at 7 a.m. And you can just kind of drag down here and you can see the progression of where Wall Street's putting its money. It's honestly a very powerful tool that some folks just unfortunately don't have. This is the S&P 500. You have the Dow Jones, Russell NASDAQ 100, Russell 1000, Russell 2000. I mean, heck, we even have crypto, right? In fact, if you were to, let's say, for example, click on this, and there's an interactive a chart that you can do. You can, like, let's say, click on the company. If you can't see it, you can click on it, and then it'll basically show you a pizza. It looks like pizza, but it's definitely not that. Okay, so just to give you a little bit of kind of an update on what we've been doing here. I'm trying to think what else. Yeah, so if you were to go up to our I believe gamma squeeze. We've been talking about MMAT for quite some time. I lay these here to show you, MMAT has been on our radar for quite some time, right? And it's important to take in conjunction these stocks and go to our stock screener tools on here, and as well as our um, top gainers. And what you can do is you can track to see what stocks are actually gaining and what are losing. And you use that to assist you. You can look at the volume. But overall, yesterday the stock did really well. Again, you have to understand, um, you know, this is not a long-term investment, right? This is for day trading. This is not, I would say, this is under speculative, right? So if you were to track this, this is a good 36% gain. It's a lot more because they don't show you the intradays, but you can see in that good old 40% gain. So take advantage of this data here, because it's always sending. It's working. It's always sending. It's always sending information. Also, what else I wanted to show you? Yeah, exactly. It just sends information. All these social spikes, these graphs that we have, you just get bombarded by all of this data that just continuously just gets sent. All this data, use it to your advantage. All right, so let's go ahead and back off here and just talk to you guys a little bit, and then we'll go back into the data. Literally long time no see. I miss you guys so much. I'm been working hard at the hospital. It's definitely been a very rewarding, difficult experience. But the only thing I must add, the only thing I must add is it's definitely need to add the gym into it. Um, yeah. So unfortunately, we have some comments on here, so we'll just yeah. Well, I'm gonna remove that because that's not nice calling someone that. So, yeah. So we'll go ahead and we will talk about a couple things here about where have I been and whatnot. But I wanted to share with you an experience. I find it interesting. I've been hanging out with a lot of doctors, and I just find it interesting that, um, it's quite marvelous how, how people think. I was in a group, in a discussion, and I was just having my lunch uh, privately, and um, oh, he was saying something about open. Yes, let me share. Yeah, so he was saying something about Open Door. So I haven't looked too much into it. Right now, the housing market is definitely on a fritz. Um, Open Door is with the Federal Reserve increasing interest rates and most likely sustaining these interest rate hikes for quite some time. The housing market is definitely in trouble. Um, So I would need to take a look at what exactly has been going on with Open Door, but the stock has definitely seemed, and especially in the past month, is down 21%. So I have to see if that is a market maneuver or if it's actually a particular significant movement. But overall, let's see here. So I guess we could talk about it right now, and this is the first time looking at it. So, Open Door here. Let's see. Open Door discloses series of top level changes. CFO Wheeler becomes CEO. Yeah, I would need to do some due diligence on what's happening with them, but I don't expect them to anytime soon to have a good time, especially with the interest rate hikes that we have. But once the Federal Reserve eases their monetary policy, things will get a lot better. And I'll give you my predictions on when that's going to happen. But what I wanted to do is I was having by the way, I'm really exhausted. I've been up since 2 a.m. I sleep at 7. So 7 p.m. I wake up at 2 a.m. and I work from 2 a.m. to 6 p.m. So it's been a day. But what's interesting is I was with this group of doctors, and when someone started talking about stocks, it got my attention. I started listening to these folks, and I was like, "Oh wow!" And I was hearing the conversation. I didn't want to intrude because who wants to be that guy? Going in talking about it's like I was just curious because a lot of these folks, I'm just curious to see what is their knowledge about stocks, right? So, hmm. one person was saying, one person said, one person caught my mind and said, I'm not really interested in the market. I don't really care about stocks. I don't care about investing. I don't care. Um, I just, don't like to invest. And obviously that person's young. It was a young doctor. It wasn't like a 50, 60-year-old doctor. And I kind of struck me. I was just like, I was like, I wish I could see that person's 60-year-old, 65-year-old self. And I would love to ask him to comment on those comments that he did said when he was earlier in his life. I find it very interesting, to say the least. I find it interesting. And you can comment down below if you guys seen the same things with healthcare. Healthcare is a weird beast. It's definitely a really weird, just a weird thing. I can tell you guys some stories that I experienced that might piss you off, showing us how terrible our healthcare system is. It's definitely it's a moving target, to say the least. Um, so in terms of what's happening with Clove here, well, from what I see, Clove is doing everything they need to do. They're decreasing costs. They're burning bridges that don't make them money. I think they're doing a definitely good job. I would say all they need to do now is essentially go on their path of profitability, making sure they decrease their MCR and cut things that unfortunately don't decrease their MCR. But honestly, as it says, just business as usual. No, yeah, 50 and 60 is young. I've had patients in their 90s. No. I was just I find that I just relate to a lot of 50 and 60-year-olds. Have you guys experienced that where you relate more to people older than you? Um, you know. So in terms of bankrupt, well, what are the criterias of bankruptcy? Well, obviously cash burn, right? Which they already filed the dilution factor if they do wanted to do that, which they said they're not going to do it in post 2023 2024. They're decreasing costs. As of now, they have enough money. If they don't decrease costs and if they do the same business as usual have they've been doing, they would have 9 quarters left based off of my calculation I did. Correct me if I'm wrong, guys. You know what? 75. Yeah, around $75 million quarter burn, around 600. Yeah, around that, about 9 quarters. So I don't think that they are there. I think that they're going to. And by the way, 9 quarters is about 2.25 years, right? I don't think that they're there. I honestly think that they're going to decrease their burn much more significantly, um, and become profitable. If you add, that we're looking 2022, 2023, 2024. If you add that 2.5 or whatever, we're looking at 2024, 2025, right? That's when and then by then the market will become easier. So so you have to kind of look at context, guys. You have to study the context of where we're in. Okay. So if we can go ahead and open up a couple of things here. Okay. If we can open up a couple of things. And if we can go to our smart money, dumb money. Oh, by the way, for all the stock requests, I'm very happy that this is doing well. We're going to go ahead and talk about them. We're going to go ahead and talk about them when we go ahead and do our bi-monthly meeting here. But what I wanted to do is I wanted to first open up the equity hedging index. Okay. Yeah. Around 700 million. So I said 9 quarters, and $75 million cash burn 9 gives us around 675 million. So exactly. So that, that's around that. Of course. So if you go ahead and look at the equity hedging index and you look at the time frame here. Normally, personally for me, I like to be a consumer, a buyer of the market, especially bullish when we are above the green line. Okay. I love this. Okay. And, this was a great time. And if you track up here, you can see this is the COVID-19 drop. If you don't believe me, just go down here, 2020, right there, 2020. Right. So every time we see a peak here, I become extremely excited over the market. Now, it may seem that I'm not excited right now. It's because I'm just like excruciatingly, I'm just really tired, right? It's just, I'm working on emergency generating batteries right now. Okay. So if you go ahead and track down, I usually have more energy, right? If you go ahead and track down, I don't like this market. Whenever we're here, I did not like this market one, but I hated the crap out of this market, right? It was a market of speculation. It was a market of just pure silliness. Okay. Well, now things are starting to correct. A lot of SPACs got destroyed, right? And now we're in a time point where it is good to buy again. It is good to look at companies to essentially see the value of the company. Okay. So now that we went ahead and went through the equity hedging index, I want to go ahead and look at the hedge fund exposure. Okay. Now let's go ahead and let's do a bigger time frame. This is from 2008 to 2022. By the way, let me just go back. The equity hedging index was from 2008 to 2022. Okay. Give me one moment. Let me go ahead and remove this thing that keeps popping up here. There it is. Okay. All right. So going back to the hedge fund here. All right. Let's go back to COVID. Okay. If you go track all the way down here as a straight line, you would see whenever you're in the green territory, it's a great time to buy. Hedge fund exposure rates, are essentially in the low frame here. Stocks usually outperform. Indexes outperform when you're at the tip top. Okay. So just track it. You see this dip here? We were here. That was 2018, going, the December 2018, with the whole China tariffs, Chinese stocks fell. We use the data, that we have to essentially conglomerate the information to make a, and a decision, right? So we're here right now. We're here. We're at this area and we're getting multiple data points. Now, if you look at smart money, we're seeing smart money again get excited, right? Whenever stocks go down, dumb money sells, smart money buys. It's the same concept. Do opposite of retail investors, you'll be great. Okay. Now we're starting to see smart money come up again, which means that we may start going down again in price. Stocks may come down for another dip. And then dumb money basically does its selling. Okay. So now that we, just kind of tell you kind of the data that I'm looking at, kind of what's been processing my mind. The other data, which I've talked about since last year, if you pull up my videos, I said, the Federal Reserve is trying to create a soft landing. And I specifically stated that, if you look at the history of the CPI data, every time you try to decrease interest rates, my apologies, every time you try to decrease inflation by increasing interest rates, right? Or just by trying to decrease inflation, you get a recession. Regardless of how you cut it, regardless of how you cut the onion, how you you're gonna cause a recession. The question that we have right now is how deep is this recession going to do? Like how deep are we going into this recession? And that's the question that a lot of folks, a lot of billionaires, a lot of people that manage, that's all the questions we have in our mind right now is how deep is this recession going to be felt? Okay. And some folks think it's not that deep, and some folks think, it's going to be deep. And the ticking time bomb is personal savings. When is that going? We have a graph on that on the allstocktrades.com website. When is that going to drop? When is personal savings going to drop? Another thing is when are people going to run out of the use of credit cards? More specifically, HELOC loans first, and then credit cards. Remember I told you last week or 2 weeks ago, I said, people are tapping into their HELOC homes because that's how essentially they're surviving. And it's at 7%? It's a lot more bearable than what you call it, credit cards. Okay. So answering the question of the personal savings, and we'll go ahead and please ask questions. Going ahead and looking at the personal savings, okay, we had a really weird. Just going to zoom in on from 2015 to now. We had this huge self-inflicted recession in gray, and we have money printed like no other. This is the personal savings rate, okay? And now look at where the money's personal savings is now. So I'm going to go ahead and I'm going to reload this, okay? So we can get the whole graph. I mean, guys, we're at levels that we haven't seen since what, 2005? Definitely a lot lower now between the 2008 financial crisis, right? So we're at levels, that we haven't seen before. And, the question is once this runs out and then people get laid off, what's going to happen? Okay. Obviously the stock market, people are going to tap into their savings, right? Their stock market, their investments. And maybe this is what they needed to do, right? To essentially drop the market, to finally get retail to capitulate. That's the goal right now, is to get retail to capitulate. That's what's happening right now. If you wanted the answer, that's the answer. They want people to stop spending. They want discretion, all that thing, so inflation can go down and be done with it. Now, let me give you the other piece, and maybe you've heard this from reading, and so it's good that we talk about it. We haven't had now. In fact, let me just go ahead and just give you the graph here. I think it's better to give you a graph, so it's sometimes very hard to communicate what's in your mind. Let me see here. Okay, inflation rate. Okay, so let's go ahead and open up the inflation rate. Okay, good. All right. So let's go ahead and open this up. So if you go ahead and open this up, okay, I want you to look into kind of where we're at right now. This is from 1950s, you get a little before that, right? All the way to 2022 to today's current value, okay? The blue line is the consumer price index for all urban consumers, all AIMS in the US city average. And the second line is all AIMS, less food and energy, subtracted food and energy. So what you're going to do is you're going to find two graphs. Obviously, the red is going to be under the blue because it's not including food and energy. I put them both on there to get a general view of things. Okay. So I just like I said, every time the feds wanted to drop inflation, the gray line is a recession. You get a recession. A drop, recession. A drop, recession. Another drop, recession. A drop, recession. I believe Paul Volcker was here, right? A drop, recession. Drop in inflation, recession. A drop in inflation, recession. And now we're getting a drop in inflation. Trying to get a drop. And I believe the drop is real, okay? So no matter what politicians, no matter what anyone tries to tell you, you look at the history, and Albert Einstein said, if you do the same things again and you expect different results, then you're insane. Most likely we're going to have a recession. Okay. So there's that. Okay. Another thing that I would like to mention, just I'm giving you these data points, and then we're going to go in and we're going to suck in all of these data points, and we're going to come together, and we are going to come together and formulate a hypothesis. I just don't want to tell you, oh, this is what I expect. I expect this thing to happen 2024 to 2025 plus bull market. Okay. Oh, good. Okay, great. But what I want to do is I want to give you my reasoning. Like, look, how am I breaking this down? Because I think that's where the money is, right? Again, we want to help, retail investors out. The citrus, this damn little blue thing that keeps popping up, it's Citrix, it's damn hospital. It told me to remind you later. It just keeps bugging me. God, it's annoying. All right, sorry about that. I just want to just keeps popping up there like little bouncy cat. Okay, so I don't know if you noticed it, but it's kind of annoying there. All right, so now that we talked about inflation, I want to go ahead and talk about the unemployment rate. Now let's go ahead and talk about the unemployment here, okay? Whenever we have unemployment levels this low, it always, most of the time, precedes a recession. Unemployment low, recession. Unemployment low, recession. Low, recession. Low, drop it low, there's a recession. Drop it low, there's a recession. Drop it low, there's a recession. You drop it way low, there's a recession. That was self-inflicted. Unemployment rose up high, then it dropped real low, lower than lower, and then guess what's going to happen? A recession. Now, what I like to do is I like to break it up. What's the unemployment rate for high school grads, no college? And then what's the unemployment rate for bachelor's degrees? I know it's really insane here. I mean, it's a pretty big difference, and it's always been a big difference. It's kind of, really fun to look at this data. But again, it's low. It's really low, guys. Okay. So I take a look at that. Okay. This tells me, okay, it's a strong economy. And there's certain levels of criteria that I look at. Like I'm going to give you an example, part of our mastering stock market course here, one of the downloadable files, risk indicator for owning stocks. So let's go ahead and download it, shall we? Okay. What I like to, there you go. What I like to do is I personally like to look at, these are unfavorable and favorable conditions. I like to own stocks here. So I go down here. I said, is there a flat yield curve? If it's inverted, no, unfavorable. If it's positive, it's great. We're inverted now. Unemployment rate, where is it? It's near 3%. Unfavorable conditions. S&P PE ratio, we'll look into it. Most likely we're near here. Time since last recession. Yeah, definitely. It's been a while, right? I don't count COVID as a recession, okay? Market cap to GDP, right? ISM manufacturing data. The Fed pursuing tightening monetary policy. Yep, they're doing it right now. Not a great time. Holding. Remember, I did stage 1, stage 2, and stage 3. Loosening, and this is what we're waiting for. Okay, so again, I'm breaking this down. Some folks don't like long videos, but it's just, this is hard. This. I mean, how do you put 10 years of experience in a 10-minute YouTube video? You just can't. I'm having a conversation with you guys. I'm looking at your comments here. Miss you guys a lot, right? But I'm hoping that we're breaking this down, and I hope that you're watching the video here. Okay, like looking at what I'm showing, because it's very hard to kind of paint, just talk about it without seeing an image. Pictures say 1,000 words. So we looked at the unemployment rate. Okay, somebody asked an important question: wouldn't the technical recession be 2 quarters also count? Well, I agree with you. We already had that, right? But what's interesting is the answer to your question is the NBER based recession indicator. The NBER, NBER. How do you?
NBER.
Yeah, NBER, which stands for NBER, the National Bureau of Economic Research. Okay. Now, I bet you this is a government company, no, or is it an organization? And I honestly, if you look at the people running this, it could be politically based, but these are the people founded in 1920. These are the people that determine whether a recession starts. And we have this thing, part of your mastering course here, is every time you see a blue, like a blue little box, that's when they said, we declare a recession. Okay, a little maybe not like that. So we had a recession here, we had a recession here, and we had a recession in 2020. What's interesting is let's kind of zoom in here. They haven't called a recession yet. And what I like to do is I like to look at I put the inverted yield curves here. I put the 10-year minus the 2-year and the 10-year minus the federal funds rate. Originally, remember when I said, guys, I've never seen this before. the 10-year minus the 2 is going down, but the 10-year minus the federal fund rate is going up. I've never seen an inverted sideways yield curve where the 10-year minus 2 is inverted and the 10-year minus the federal funds rate is going up. I said this when I was in Minnesota, if you don't remember, right? Well, now they're both going down. Okay, let's go ahead and zoom out a little bit. Yeah. And then now, every time, you can see that every time this inverts, what do you see? Inverting recession. They call it recession. Inverting recession. They haven't called it yet, but I bet you they will soon. So that's why they don't show it on the chart. The NBER has to declare it. It's a little factoid. Okay. So now that we looked at that, there's so many things we got to look at. I mean, there's so many things, but I'm going to cut it down to the main thing. So now that we went ahead and talked about CPI, I want to go ahead and talk about the main important thing. Okay. We haven't, I can show you the federal funds rate. Just picture it in your mind. I can show you, but the federal funds rate, we haven't seen inflation this high since, in 40 years. Okay. We haven't seen that. There are people managing money. There are CEOs that are managing businesses that have not managed the business in an inflationary time, that have not managed the business while the Federal Reserve was being the most aggressive it has ever been. Okay. So with that, the stock market, which we like to call a free market, which to break it to you, it's not, has become more of a economic story than that of a fundamentals, which is okay because it's short term. Because in the long term, the fundamentals will prevail. Okay. So my speculation and my prediction is that 2024 to 2025, I would say 2025 is going to be a crazy bull market. I believe that is going to be such a beautiful time. Okay. And I'm not retiring in 2 years. Heck, I'm not retiring in 10, 20, and hopefully not ever, right? So I'm taking this I'm taking advantage of this. This is a unfortunate. This doesn't come very often. This type of market doesn't come very often, and it's the type of market where your children will say, "Man, Dad, if I was, alive during that time, I would have bought in a lot." I want to tell my future son, "Don't worry about it. I got you." Okay. I don't have kids, but I'm just kind of give you kind of perspective. Okay. All right. So there's that. So now that we went ahead and we basically broke down the 10-year minus the 2, the 10-year minus the federal funds rate. We broke down the CPI. We broke down the unemployment rate. We broke down smart money versus dumb money. We broke down the equity hedging index and the hedge fund index, the hedge fund exposure index. I hope that gives you multiple data points coming at you, and you can come together and formulate a thesis. Okay. And that thesis, I would love to hear what you think down below regarding that thesis. And the beautiful part that I must say is that as retail becomes bitter, as retail becomes negative, we get to a point where we get to this thing, this psychology of the market, where, let me see here, when we get, I think it depends where we are right now, but I'm just going to click on an image here. It depends where we are, but I think right now we may be here. Anger. Many are angry now. Some have not capitulated. I mean, Wall Street is very greedy. They want more. But I think personally, mentally, people are here. Okay. They're very angry, right? And this is honestly exactly uh, um, this is perfect. This is this is great, right? Because now depression is going to come in, and then people are going to go from disbelief, hope, and then we're going to get back on 2025. We're going to get back to the same stupid cycle that got us into this mess, and then we're going to sell to these folks. Okay, that's kind of like basically how the psychology works. All right, so that is everything from that angle. Now, in terms of open door, I'm curious to see what happened. Now, again, when you have interest rates for the housing market extremely high, there's a bit of a problem that exists with that. But I usually don't read headlines um, because they are usually wrong. But I'm just going to go ahead because I haven't seen this. Let's see, just to kind of see what people are thinking. Open door. Let's see what's going on here. Yeah, these articles don't tell anything. They really are terrible. Have you read that's why we don't read these articles. They don't tell you any bit of information that's useful. Mm, mm. Let's see here. All right, so let's go ahead and take a look at the comments here. Probably going to be able to last a while. Oh yeah, that was an old comment there. Yeah, most likely, I do think this will happen, but I think they want retail investors to essentially sell, and they want retail investors to really lose confidence. And I believe that a recession would be, in their eyes, the best indicator for that. So I definitely I'll do a look at on that. In terms of Clover, unfortunately, Clover is not at our hospital. I wish it was. I can kind of play around with it, but unfortunately, no. Um, yeah, no, yeah, exactly. They do, and then they do a reverse split. Exactly, SEC compliance versus exactly. Um, I've been able to watch the realities of businesses and healthcare industry mixed with, yeah, absolutely. Yeah, patients, are, and the compassion from healthcare professionals. In terms of my story about what I said about investing, it's unfortunate. It really is unfortunate because I've had some classmates that basically says, honestly, I don't even want to make a lot of money. I don't even know what to do with that money, and and that type of thinking. Yes, it's great, it's beautiful and dear, but if you don't fight for your value, someone else would love to take that money from you. And it's most likely going to be the hospital systems and the insurance companies, in terms of how healthcare is structured. And just like kind of how, Americans kind of talk, about their government, it's like, hey, don't take my money. I know how to spend my money better than you. Right. And honestly, any state funded, government funded thing hasn't what government funded thing has been good that you've dealt with other than our beautiful military? That's the only thing that we can do right, thank God, right? But anything, DM, the drivers, it was a DMV, all, drivers motor vehicle division, whatever, all these things, it's very terrible, very slow, right? Let's see here. Oh, of course. In fact, we just talked about alcoholism just right now, like an hour ago. Very true. It's so true. Are you in healthcare? You know so much about healthcare. Let's see here. I'm just reading the comments. Exactly. And here's the thing about the market. Everyone is worried. My question is, hey, what's changed, right? What's changed? Well, I mean, they got a new CFO. They're about to become, they said, profitable by next year. I mean, what's changed? I always ask myself, what's changed? in this context. The company has more money in terms of revenue than they had last year. They have more clients and they're about to burn less. I mean, honestly, I always have to, I always kind of look at those things, but I'm not seeing anything regarding open door here. Let's see. I'm reading here. Let's see what they say.
Who held the position for 2 years, will take charge of the company as chief executive officer, taking over from Eric Wu. The company said Wu will transition to a new role as president of Marketplace effective immediately. Chief accounting officer Christy Schwartz will become interim chief financial officer until a successor has been identified to become permanent CFO of the company. Wheeler will join the board of directors, while Wu will continue to serve as a member, and John Rice has been appointed lead independent director. The changes have increased the board size to 9 people. In addition to the above changes, President Andrew Loaki has resigned from his role to pursue other oppo.
Yeah. I'm not too sure about this, but we're going to have to see exactly how they play this one. Based on how their financials were going, I have to take a look a little bit deeper about how they were going. I would say right now the housing market is in deep stress, and they had to sell a lot of their houses at a loss because most likely the market, the housing market is going to go down a little more, about maybe 15, 25% more, a little bit more on the lower end than high end. I would say 5 to 10%, to be quite honest with you, but it depends. It depends. I'm definitely looking at Open Door. One of our legendary investors, Bill Miller, is in it. Has a reported price of $3.11, which constitutes 0.02% of his portfolio. The revenues, just I would say gross margins need to be looked into. Net income is still negative. Earnings per share, obviously negative if the net income is negative. Dilution, definitely an issue here. Free cash flow becoming less negative from especially 2021. We're gonna have to see, but their working capital has been increasing. In terms of the financial health of the company, they do have a lot of debt, most likely, in terms of their current ratio. So that does not look good, and I'm curious to see what happened with that. Looks like their debt has increased. So we're gonna have to see what's going on with that. So, again, with the market, I would say, you want to find companies that, there's two ways you can go about this. You can find companies that are free cash flow positive, net income positive, and that are essentially disrupting the space. Like for example, our semiconductor chip plays, they're doing phenomenally well. But then if you want to make crazy amount returns, it requires that there's risk, right? And you want to find companies that have a lot of, tailwinds versus headwinds. Right now, the headwind is the housing market was overstretched, and it's going to take some time for the housing market to get back into how it used to be. So I would say Open Door needs to hang on a little longer for things to re-equilibrate again. And once we get into that technological world that we are going to start, if not have started already, versus all of the investments we've been making in chips, if that does not ring a bell to how much semiconductors and silver and all the things that we need to build the fourth industrial revolution, if that doesn't ring any bells, I don't know what will. But personally, for me, I like companies that have very strong tailwinds that are can't be stopped. What can't be stopped? Well, age. You can't stop age. We're aging right now as I speak to you. We get, so Clover's, 65 years of age. Every day we get 10,000 possibly new clients to add into that window of opportunity, into giving them the best service that they could get, right? So that's kind of the thing that kind of go in my mind in terms of all that. And then how can we acquire these customers in terms of the customer acquisition cost and the opportunity to develop a SaaS from all that data that gets injected within the Clover Assistant. So these are the things that I kind of go in there, and the longer this company is able to get this data, the better they will become. So I would say right now, Wall Street, is definitely in a negative territory. They're very upset. Everyone's sad. No one's making money in the market. And it's just a process that this non-free, Federal Reserve dependent economy was generated. But it's just part of that the cycle, which goes, when it goes down, it goes down hard. But when it goes up hard as well. Right. So it's all about sticking in, and how long one person can stay in. And usually first the margin accounts get run out. People that did margin, they were gone, right? Then it's the people that don't have any conviction. They just want to just start over again. There's so many little things, retails, just different ways they capitulate, and the biggest one is a recession. Okay. So there's kind of my analysis, breaking everything down. Miss you guys a lot. I just wanted to kind of let's see here. Isn't Let's see. Yeah, exactly. And also, the stock is associated with, a SPAC. It's associated with Chamath, and he has a lot of enemies. It is what it is. But, once the company becomes profitable, again, the CFO is smart. I mean, just look at the company he came from, right? Once the company becomes profitable, no matter how much SPAC smell you have, if you're a profitable business, you know, your intrinsic value will come true, right? Okay. They did say they would be doing some restructuring and dropping high cost programs. So I think big money is just waiting to see what Clove does. Exactly. The money, Chamath also said this, and it's so great. The money, okay, because we have the bonds. Bonds are high, right? Bonds are like 3 to 4%. The money in front of you now is worth more than the money 10 years away from you, right? So many are selective with how they spend their money. Okay. So those are the things that kind of how things are going. So, all right. That was a lot. I tired myself out. Definitely tired myself out here. I miss you guys a lot. Just wanted to, this was definitely a long live. Just wanted to share with you guys my thinking on the matter. I didn't plan any of these graphs to show you. I just kind of showed them to you on a whim of just trying to explain to you what I've been thinking about over the past couple of months. It's very hard to it's very hard to explain the stock market when you don't have the data. This data is privileged. It's unfortunate, but we're trying to democratize it to everyone. It's very privileged, and we're definitely trying. But if you look at institutions for Clover, what are they doing? Are they selling? No, they're adding, right? I mean, it's just, you got to look at these types of things, and that's just one data point. That's just one data point, guys. You just can't look at institute. You got to look at the whole person. You got to look at the whole investment. When you go ahead and you want to marry somebody, when you buy a stock, you want to marry the person, right? You don't just marry them on their looks, right? And I hate, I hate to put a slam on Americans, right? Right, because I'm American. But we got one high of a divorce rate, don't we? Right? Don't we have a big divorce rate in this country? I don't know if it's the highest in the world, but I know, honestly, is it the highest in the world? Alexa, Alexa, stop. Man, Alexa, which country has the highest divorce rates?
The country with the highest divorce rate is Portugal at 94.44%.
I did not know that. Interesting. Now, I would love to take their investments and their retail data and graph it on their marriage, and I would love to see if there's some connections. When someone marries, or when someone wants a date, they always look at kind of the looks, right? Like, how does this person look? Oh, they got this and that. Ooh, that looks good, right? It's always surface, right? When people invest, they always look at the price, right? I think Warren Buffett said, in Wall Street, everyone knows the price of everything, but the value of nothing, right? So, we're going to be covering this for quite some time. I just find it interesting, kind of the dynamics of investing and how people can go from optimism to just anger, right? To just literally anger. And, it's kind of the, and some of this anger, has been directed at me, right? So some of this anger has been directed at me, and I'm just like, wow, okay. It's quite interesting. I see these cycles, I see them play in the market, but I don't normally pay attention to the commentary. But now that I'm, doing the, YouTube and trying to educate, stimulate, and inspire the next generation of investors to make smart decisions, it's quite interesting to see people's, commentary. It's definitely interesting to do. I must say. Let's see here, and also, Chamath, we can definitely hype him up. He did make incredible decisions with Bitcoin and everything, but he was operating in an era where the Federal Reserve was easing, slash tightening, and then easing, right? The real test now is, can these companies operate in such a toxic environment? And the biggest answer to that is, not even the government can operate in these toxic environments, because the government, if you keep interest rates as high, their ability to pay this debt off becomes larger than the amount of money that's coming in from taxes, right? Which is why they're, making you pay 600, making your report to all these things now, because they want their money, right? And they're, they said they're going to go after the rich, but they're going after everyone else, right? So once this happens, guys, I think when they're not able to satisfy the obligations to defend the United States with military expenses, they are going to start pressuring the Federal Reserve. But right now, their job is simple, is to essentially increase unemployment levels, to decrease inflation, and whoever has capital that can deploy it at a dollar cost averaging time points is going to be one happy customer. It's going to be one happy person in the future. Okay. All right. Well, I love each and every one of you guys. I hope, please, if you've just came in right now watching this video, I recommend watching the whole thing. Now, maybe I can cut them up and, edit them and then post them in on YouTube to help digest them easier. But I put in a lot of important information in this video. I didn't think I was going to talk to you about this, but, that's where the discussion led. Okay. Well, I'm going to go to bed, and I'm going to wake up in about 5 to 6 hours and study some more, go to the hospital, and take care of amazing patients. Yeah, let me know what you guys think of the video here. Let me know what you think the unemployment level is going to go up to. I think anywhere between 4 to 5%. I don't think they're going to make it go more than that. Yeah, I'm gonna hit the hay. I wanted to talk to you guys, slow down a little bit, kind of explain what's going on. Just a kind of just a quick, if you're just tuning in from our mastering side and our Alstock alert side, I did add another section here. Okay. It's our auto heat map, which means that you don't have to do anything. You just click on it to look at the data. And it'll literally give you hour by hour, as long as New York is open, you get a chart to see where Wall Street is putting their money. Okay. You have it here too. And for the Dow Jones, and for the NASDAQ, and for the Russell, and for the Russell 2000, and for crypto. Okay. Crypto's pretty red, right? Okay. So we wanted to kind of give you guys more resources. There's a lot of resources here. We wanted to give you more resources to essentially help you navigate this market. Okay. All right, guys. We're going to make one. I don't. Oh, where'd you? Sorry. I don't know. I don't have a specific date. But I'll definitely work on it to kind of talk about all the things that's happened. Institution investors, new people that come on the board. Definitely we will. But the biggest thing right now is profitability. Profitability is king. If they can make money, their value will follow. Okay. All right. Yeah, so we tried to make this, especially this. I think this is a recession. Everything that you see here, there's a lot more that there's a lot more that I did not show, but everything that you see here, all of our software, if our brain machine, which you can do fundamental analysis, anywhere between our graphing tools that you type in the stock, everything from auto dark pools and there's more data than your brain can handle, from graphs that talk about volatility of Clover, analysis that only if you have, with simple support resistance lines and everything, all that is for $11.99. And whoever's in it will be grandfathered in. We will be increasing prices, not now, most likely in a year, 2 years from now, once this recession is over. We're going to be increasing prices massively for the monthly. But we're keeping it low on purpose to respect the retail community, to give them an opportunity, because all this is expensive. We have a collaboration with this company here. Normally, normally, if you were to get access to this data, it would cost $70 a month. If you were to if you were to just open up a, let's go here. If we were to look at the pricing here, and go here, it's $69 a month, and every year it'll cost you $699. And that's just one of the software, Tradalytics. We have way more other things. So you can do the math and calculate it for yourself. But yeah, so definitely, I would expect 2025, 2026. But until then, follow us on YouTube, and we'll definitely be releasing information on kind of where the market is headed, and doing some teachings as what we did today. But yeah, there's a lot here. I got to make a tutorial. It's just I keep adding things. So I'm going to make more tutorials. Also, we meet 2 times in a month in our bi-monthly meetings here, where we talk. So I always try to provide more value, and just put it all in one little bundle here. So all right, guys. Well, I love each and every one of you. Thank you for the question. I know this, it's hard to, when you look at the website, it doesn't I try to make it easy, showing you all the check marks of what we offer. It's a lot, right? It's a lot. Think of this as a Bloomberg terminal, where you have access to any financial piece of information you can find. So that's pretty much what it is. And this information costs money, unfortunately, which is why retail investors always lose in the market. I mean, it's like it's going to a marathon with COPD. That's literally what it's like when you invest in the stock market. It's like going to a marathon while you have COPD, which people don't know. COPD, it's chronic obstructive pulmonary disease, right? You're not going to win, right? That's pretty much what, sad part. All right, guys. Love each and every one of you. Peace out. I'll see you in the next one. And yeah, that's all. Comment down below on the main comment sections, and I would love to read them and hear from you.